Hey everyone, welcome to this explainer. I am so pumped you're tuning in today because we're about to build your foundational knowledge of the Indian stock market completely from the ground up. Think of me as your mentor for the next few minutes and consider this explainer your ultimate blueprint. We're going to totally strip away the noise and focus strictly on the mechanics of how the market actually works, when it moves, and exactly what it costs you to participate. But first, let me throw a serious question at you right out of the gate. Do you actually know the true cost of your trades? So many people jump into the markets and they're only looking at the buy and sell price of a stock. But right underneath the surface, there's this absolute labyrinth of hidden fees, complex tax structures, and really strict timing rules. And honestly, if you aren't fully prepared, these elements will silently, but steadily, eat away at your portfolio's profits. So today, we're putting an end to all that guesswork. Okay, let's dive right into our blueprint. First, we'll look at accounts and core instruments. 2. Equity market timings explained. 3. MCX commodity trading hours. 4. FY27 capital gains taxes. And 5. We'll finish up with a breakdown of trading charges. All right, kicking things off with Section 1, the prerequisites, accounts and core instruments. So entering the market requires a very specific, linear, 3-step interconnected path. You literally can't just jump in. First up is your bank account, which obviously holds your actual cash. Second is your trading account. This is your main interface with the broker. It's what you actually use to hit those buy and sell buttons. And third is your Demat account. Think of this as your digital vault. When you buy shares and hold them overnight, they get safely deposited here in an electronic format. You absolutely cannot skip any of these. They work together as a single, seamless pipeline. Once you've got those accounts set up, you have this massive playing field of core instruments you can trade. You've got equity intraday, where you buy and sell within the exact same day. You have equity delivery, where you hold shares for the long haul. Then there's the high-octane world of futures and options for leverage. And hey, if you prefer a more hands-off approach, you've got mutual funds or ETFs, exchange-traded funds, which are incredible because they let you trade baskets of assets, like the Nifty or gold, in real time, just like regular stocks. Moving right along to Section 2, the clock. Let's get into equity market timings. I want you to think of the specific 15-minute window like a runner stretching before a massive marathon. Before the market officially opens, we have the pre-opening session from 9 a.m. to 9:15 a.m. This exists to absorb overnight news and basically curtail extreme, crazy volatility. First, orders are collected between 9 and 9:08. Then, from 9:08 to 9:12, the exchange matches all that demand and supply to find a fair equilibrium price. And finally, there's a silent buffer from 9:12 to 9:15 to ensure a perfectly smooth transition. No active trading happens here at all. It's all about finding balance before the opening bell rings. And then, bam, the bell rings. From 9:15 a.m. to 3:30 p.m., Monday through Friday, the regular session is fully live. This is the main marathon, guys. It's when all active equity, ETF, and derivatives trading happens on both the National Stock Exchange and the Bombay Stock Exchange. For 6 hours and 15 minutes, the market is completely fluid. But wait, the market doesn't just pull the plug instantly at 3:30. There's a vital and honestly often overlooked cooldown period called the post-closing session, running right up until 4 p.m. The exchange uses this specific time to calculate the official weighted average closing price of the day. You can actually place orders here, but they're only going to execute if buyers and sellers agree exactly on that final closing price. So that's equity. Let's switch gears to Section 3, the marathon, MCX commodity trading hours. Like we said, your standard equity day wraps up at 3:30 p.m. But man, if you are trading gold or silver on the multi-commodity exchange, your session runs all the way from 9 a.m. until 11:30 at night. And during U.S. daylight saving time in the winter months, it even extends to 11:55 p.m. Why so late? Well, because precious metals are globally priced. The MCX literally has to stay open late just to align with the heavy trading activity happening in New York and London. And if you thought staying up late was the only challenge, take a look at the morning schedule. Commodity traders have to be at their desks even earlier. The MCX pre-open session kicks off at 8:45 a.m. for order placement. That's a full 15 minutes before the equity guys even start their pre-market. It really is a marathon in every sense of the word. All right, on to Section 4, the rules. Specifically, the new FY 2026-27 capital gains taxes. This matrix of taxation is definitely not a one-size-fits-all deal. If you hold equity for less than 12 months, your short-term capital gains are hit with a flat 20% tax. Hold it for over a year and it drops nicely down to 12.5%. But notice how gold's short-term gains are taxed at your personal income slab rate, meaning depending on your bracket, it could be as high as 30%. And check out that bottom row, debt mutual funds. No matter how long you hold them, they are taxed entirely at your slab rate. But hey, there is a silver lining here for long-term equity investors, and it's a number you absolutely need to memorize. 1,25,000 rupees. Under the new rules, this is your annual tax-free exemption limit. So the first 1.25 lakhs of your long-term capital gains and equities are completely exempt from that 12.5% tax. You are only paying taxes on the profits that exceed this exact threshold. Now, I really want to pause on debt mutual funds for a second, because this is a major structural shift that caught a lot of investors totally off guard. For any units purchased on or after April 1st, 2023, the government completely removed the long-term capital gains benefit. It doesn't matter if you hold it for 1 year, 5 years, or 10 years. Every single rupee of profit is treated as short-term and added directly to your taxable income. Which brings us to our final part, Section 5, the hidden drain. Let's do a complete breakdown of trading charges. To really make sense of what you're paying, you've got to split your costs into two distinct buckets. On one side, you have the platform brokerage. This is the fee your broker, your actual trading app, takes as their cut for facilitating the trade. On the other side, you have statutory charges. These are the mandatory, totally unavoidable taxes and fees levied directly by the government, the stock exchanges, and the regulator. The really good news here is that the industry has evolved beautifully for retail investors. Today, discount brokers like Zerodha charge absolutely zero platform brokerage for equity delivery and mutual fund investments. If you day trade or use futures and options, it's usually capped at a maximum or just 20 rupees per order. But if you're just buying a stock and holding it in your Demat account, the broker's fee is a perfect zero. But, and this is a massive but, even with zero brokerage, your trades are definitely not free. You simply cannot escape that statutory bucket. Every single trade gets hit with this rapid-fire list of charges. You pay STT on delivery and derivative trades, you pay stamp duty to the government when you buy, the exchange takes a transaction fee, the regulator, SEBI, takes 10 rupees for every crore traded. And to top the whole shebang off, you pay an 18% GST on the brokerage, exchange, and SEBI fees combined. And then we have what I think is the trickiest hidden fee of them all, the DP, or Depository Participant Charge. The depositories, like CDSL, charge this fee whenever shares physically leave your Demat account. So this only happens when you sell delivery shares. It's usually between 13 to 18 rupees plus GST. And here's the real kicker. It's charged per company, per day, regardless of the quantity. Think of it exactly like an exit toll booth. Whether you drive out with 1 box in your trunk or 1,000 boxes, you pay the exact same toll. Selling 1 share of Reliance or 1,000 shares of Reliance on the same day costs the exact same DP charge. One last thing on fees for the active derivative traders out there. You're going to need to update your spreadsheets. The Budget 2026 revisions, which take effect in April 2026, are actually raising the securities transaction tax. The STT on the sell side of futures will be bumped up to 0.05%, and for options, the sell side STT will rise to 0.15%. Now, if you're into high-frequency F&O trading, these tiny fractions of a percent will dramatically impact your break-even points. Okay, let's take a quick breath and recap the blueprint we've just built today. First, you absolutely must set up your bank, trading, and Demat accounts in perfect sequence. Second, respect the clock. Equity starts at 9:15 a.m. and MCX at a grueling 9 a.m. Third, factor the new FI 27 taxes into your strategy, knowing your 20% short-term and 12.5% long-term obligations. And fourth, always calculate the hidden drain of statutory fees, because zero brokerage never means a zero-cost trade. I want to leave you with a heavy thought to chew on. Take a hard look at your own portfolio. Look at your win rate. Does your current trading strategy actually outpace the combined heavy weight of STT, GST, DP charges, and capital gains tax? Because at the end of the day, in this market, you aren't just trading against other participants, you're trading against the structural math of the system itself. Understand the blueprint, run the numbers, and trade smart. Thank you so much for joining me on this explainer. Keep learning, and I'll catch you in the next one.